Greetings to all. Now we are going to understand about the valuation of goodwill, different sums. In this sum, they had asked about weighted average method. So under this sum, A and B are the partners. They are sharing profit and losses in the ratio of 5:3. On 1st April 2018, C was admitted with the partnership for 1/4 share of the profit. For this purpose, goodwill is to be valued 2 years purchase of last 3 years after allowing remuneration. Profits to be weighted 1:2:3. The greatest weights being given for the last year. The net profit are the 2 lakhs, 2,30,000 and 2,50,000. The remuneration of the partners is estimated as 90,000. So in this sum, first we have to make a structure of profits, weights, and besides that profit into weights, that is P into W. Then switching towards this, we will get final sigma PW, that is 14,10,000, and sigma W is equal to 6. How come 6? 1 plus 2 plus 3. So ultimately we get weighted average profit is equal to sigma PW upon sigma W. So ultimately they will give you 2,35,000. Of this, weighted average profit less remuneration. So why remuneration is to be deducted? Because they had given 90,000 per annum remuneration of the partners. So ultimately we got our weighted average profit as 1,45,000. Now the step number 2, weighted average profit multiplied by number of purchase years is equal to goodwill. So 1,45,000 multiplied by 2 years. So that will give you final answer of 2,90,000. So this way our full sum will be completed of weighted average profit. Now we are switching towards next sum, and in this sum you can see there are few adjustments which is to be understood. Calculate the goodwill of the firm on the basis of 3 years purchase of the weighted average profit of last 4 years. The profits are given as under as 25,000, 27,000, 46,900 and 53,810, while the weights for the years are given directly. 1 for 16-17, 17-18 2, 18-19 3 and 19-20 4. On April 1st, there are few adjustments. On April 1st, 2017, major plant repair was undertaken for 10,000, which was charged to revenue. The said sum is to be capitalized for goodwill. Calculation subject to adjustment of depreciation of 10% per annum on reducing balance method. So under this method, revenue expenses is considered. Revenue expenses of rupees 10,000 is a capital expenditure, which is a major plant repair. They had considered as a revenue expenses. So taking into consider as a revenue expenses, they have decreased the profit. So now to rectify that, we will add this 10,000, and apart from this we have to deduct depreciation every year 10%. So 10% per annum by reducing balance method. So last year in 11th standard we have learned about reducing balance method, that is the balance what is left on that depreciation is charged. So every year depreciation will be charged on the balance things. And then second adjustment is the closing stock is valued 2018 and 19 respectively with 1,000 and 2,000 respectively. So in 2018 1,000 is closing stock overvalued. That when there is a overvalue of closing stock, it will always increase the capital. It will always increase the profit. And when there is a overvalued of opening stock, it will always decrease the profit. So that adjustment we will be making for this things. And the last part of this is to cover the management cost of annual charge 5,000 should be made for the purpose of goodwill valuation. So we will be covering the management cost, and that 5,000 will be deducted from every year's profit. So let's move on with the solution of this. So you have to prepare this. Preparation of this statement can be done by yourself also, by your own ideas also. There is no compulsion for this. This is the simplest way. So I have done this way. So particulars, profits, 2016, 17, 17, 18, 18, 19, 19, 20. So these are the profits allocated, which you can see over here I have transferred. Then comes your next step, and that is very first adjustment. What was the first adjustment? That they had wrongly charged 10,000 as a revenue. So now we are going to make the correction of that, and we will be charging them in a correct form. So here wrongly charged as revenue expenses, so 10,000. So 10,000 we are going to here add. Right now they had said that you have to charge 10% depreciation, so 10,000 at 10% will give you 1,000 as a depreciation, 1,000 as a depreciation. So this way we will be minusing our 1,000 as a depreciation. Then very next year again it will be applicable. So 10,000 minus 1,000, so that gives you 9,000, multiplied by 10 upon 100, so that gives you 900 as my depreciation. So for first year 1,000, next year reducing balance method, so 9,000, third year 810. Why? Because reducing balance method. You can see here working I have shown. Right now comes next point, that is closing stock. So when the closing stock is overvalued, when the closing stock of 2017-18 is overvalued, we have to make it down, so we have to minus that. So both here it is overvalued closing stock, so we are going to minus that. But at the same time, first year overvalued means if 2017-20 closing stock, that will be reflecting as a opening stock. You can see over here opening stock of the next year. So we will be highlighting 1,000 over here, that is here cross, that is opening stock for the next year. You can see here statement I have written in a perfect way, and same way in 1920 also 2,000 will be added. So this way your scenario will be over. And last point was management cost. Management cost is to be deducted from every year. So because they had mentioned over there in the third point, so we had deducted that management cost, and that way we finally got the answers of first 25,000 minus 5,000, 20,000, 30,000, 40,000 and 50,000 respectively. Then comes your keeping of your all in the structure of weighted profits. So profits are given, weights are given, and profits into weights are given. So now 20,000 into 1, 20,000, 30,000 into 2, 60,000, 40,000 into 3, 1,20,000 and 50,000 into 4, 2 lakhs. So ultimately sigma PW will be giving you 4 lakhs as a total, and sigma W will give you 10 as a weights. So finally weights is weighted average profit is equal to sigma PW upon sigma W, and same way in the step 2 number of purchase here we will be multiplying. So this way finally we got our final answer. Then comes next sum, that is Gupta and Bose. Now we are going to understand about super profit. Now in the previous terms I had made you understand super profit means what? Something which is excess of our expected profit. The excess of our expected profit is your super profit. So Gupta and Bose are had a firm throughout the above mentioned period, and they invested 50,000 on an average. The profit were 16,000. The normal rate of return of the industry is 15%. Goodwill is to be valued at 4 years purchase of profit in the excess of profit 15% on the money invested, value of goodwill. So you have to find out the value of goodwill. So average profit is 16,000. In the sum they had mentioned average profit is 16,000, right? And then what is the normal profit? How we will find out normal profit? So what is the capital employed? Capital employed is 50,000, and of that NRR is 15%. So 15% we have to find out. So that will give you 7,500. So this is expected profit. Like you invest 50,000 and you have got 7,500 as an income, but originally you got how much income? 16,000. So ultimately super profit is equal to 16,000 minus 7,500, and that way we got 34,000 as our final answer. It's a very simple sums, so you can do it Then comes your next sum. A business earned an average profit of 8 lakhs during the last few years. The normal rate of return is 10%. So if he invests 100 rupees, he is expecting 10% or 10 rupees as a income. The total value of assets and liability is 22 lakhs and 5 lakhs 60,000. Calculate the value of goodwill of the firm by super profit method if it is 2.5 years purchase of super profit. So in this scenario, 8 lakhs is our average profit. Normal profit is how much? That is capital employed multiplied by NRR. Now what is the investment? As we have understood that total assets minus liability is always our investment. That is A is equal to C plus L. So that way we will get 16 lakhs 40,000 as our capital employed. So normal profit we will get is 1 lakh 64,000. But originally we have to earn 8 lakhs as a profit. So 8 lakhs minus 1 lakh 64,000 will give you 6 lakhs 36,000. So final answer of goodwill will be 15 lakhs 90,000. So this way we will come to the conclusion of getting goodwill of 15 lakhs 90,000. Next sum, switching towards this. Now this is also a sum of same of super profit only. So have a look on this. I will be not explaining this because it is understood. You can see over there. Now I will be moving towards the next sum, that is 10th sum. Ayub and Amit are partners in the firm and Jaspal is admitted on 1st April. Their goodwill is valued at 3 years purchase of super profit, where the profit for the years is, so in this sum your profits are given, but in this, in 2018 and 2019 there is an abnormal loss and abnormal gain. So this total assets is also given in the sum and liabilities are given and normal rate of return is 10%. So in this case you can easily do this sum, calculate the goodwill of the firm, and answer will be 1,44,000. You can solve this sum by your own and that will be more easy for you people to do it. Then comes your next sum. From the following information, calculate the value of goodwill of the firm by applying capitalization method. Now we are going to switch on to the capitalization method. Now one thing you always have to remember, when there is a capitalization method, then there will be no number of purchase years. There will be no number of purchase years. So under this cases, total capital of the firm is 16 lakhs, normal rate of return is 10% and profit for the year is rupees 2 lakhs. Now capitalized average profit is equal to net profit divided by NRR. So this is a formula for capitalized average profit, that is net profit divided by NRR. NRR is net rate of return. So here we have to capitalize our average profit. So that is giving you answer of 20 lakhs. And then comes your net assets, that is total assets minus outside liability, that is equivalent to total capital, as we have learned in the previous lectures also. So to ultimately net assets is equal to 16 lakhs and goodwill is how much? So goodwill will be difference of this two, step number 1 minus step number 2. So that will give you goodwill of rupees 4 lakhs. So this way capitalized method is very simple. Then comes your next 12th sum. A business has earned an average profit of 3 lakhs during last few years. Find out the value of goodwill by capitalization method, giving the assets of the business as rupees 17 lakhs and external liability 2 lakhs. The normal rate of return is 15%. So same capitalized average profit we have to first find out, that is net profit divided by NRR multiplied by 100. So that is 3 lakhs divided by 15 multiplied by 100 ultimately. And then total assets minus outside liability is equal to total capital. We will get net assets as 15 lakhs. And then goodwill is equal to capitalized average profit minus net assets. Very simple formula it is. So you can apply this and then you can solve the sum. Now comes your Next sum, that is a business has earned an average profit of 4 lakhs during the last few years and the normal rate of return for the similar business is 10%. Find the value of goodwill by, now this sum is to be done by two methods. One is capitalization of average profit and another one is super profit by 3 years purchase, right? So, and assets is given 40 lakhs and 7 lakh 20,000 respectively. So, in this case, we have to simply do is, first capitalize the average profit and then final answer you will get is 7 lakh 20,000. And then over here you can see super profit is to be you have to find out super profit up to this. So we got super profit 7 lakh 20,000, 72,000 and then you have to multiply with the number of purchase years. Your answer with different methods will change every time. It will be not same, right? So by applying the different formulas you will get different amount of goodwill. Now comes your capitalization of super profit. This is most easiest part. Now when there is a capitalization of super profit, up to super profit the method is same. Up to super profit you have to find out up to super profit it will be the same, right? But then goodwill, when you are finding out goodwill, super profit divided by NRR will be application. Super profit divided by NRR will be the application. So in this particular case we have to start in a very simple form, that is first we will read the sum. Average profit of 2 lakhs is given. Total assets of the firm is 15 lakhs whereas partners capital is 12 lakhs. So we got capital invested. Capital investment is how much? 12 lakhs. If normal rate of return is 10%, then what is the value of goodwill by capitalization super profit? So first of all 2 lakhs is our average profit. So first 2 lakhs average profit is to be kept. Then normal profit is how much? Capital employed multiplied by NRR. Capital employed is 12 lakhs. It is given multiplied by 10%. That is NRR is 10%. So we will got our super profit in a very simple form. So super profit is finally 80,000. Now apply the formula of goodwill. So goodwill is equal to super profit divided by NRR multiplied by 100. Just apply the formula because here only this much is changed. That is super profit is divided by NRR. So we got answer 8 lakhs. Then comes your next. Average profit of GS and company is rupees 50,000 as per year. Average capital employed of the business is 3 lakhs. If the normal rate of return on the capital employed is 10%, calculate the goodwill of the firm by super profit of 3 years purchase and capitalization of super profit. So both methods you have to use. So first of all we will be applying up to super profit. Both the methods remain same. So just find out super profit and then apply with both the application, that super profit at 3 years purchase and capitalization of super profit. So finally we will get 60,000 and 2 lakhs respectively. So I am not explaining this, is ultimately understood by you people that this is very simple, right? Now 16th sum is full practice sum. They had asked this in the 16th sum, they had asked all four methods to be done by you people, that is average profit method, purchase super profit method, and finally capitalization of super profit and capitalization of average profit. So this can be done by you. This is a practice sum, but 17th sum we will be doing now. On the 1st January 2014, an existing firm has assets of 1,50,000 including cash of 10,000. Its creditors amounted to 10,000 on that date. The firm had a reserve of 20,000 while partners' capital showed a balance of 1,20,000. The normal rate of return is 20% and the goodwill of the firm is valued at 48,000. At 4 years purchase of super profit, find the average profit of per year of existing firm. So in this sum, they had already given goodwill goodwill is already given in the sum. So from that goodwill we have to find out average profit, right? So first of all we will find out capital employed. So capital employed will be applying the total assets minus creditors, that is 1,50,000 minus 10,000. Or you can have another form or another matter or another way also, that is partners capital plus reserves. Partners capital plus reserve will also give you same answer. So you have to understand that. So capital employed is equal to 1,40,000. You finally got normal profit. Normal profit will be 1,40,000 multiplied by 20%. That will give you 28,000, right? And goodwill is already given. And now goodwill is equal to super profit multiplied by number of purchase years. That is our formula. So goodwill is equal to 48,000, super profit as it is, multiplied by 4. So what we will do, super profit is equal to 48,000 divided by 4. So that will give you 12,000. Now super profit is equal to average profit minus normal profit. So super profit 12,000 we will apply in the formula, average profit as it is, and normal profit 28,000 we will be putting down. And finally average profit is equal to 28,000 plus 12,000. So final answer is 40,000. That ends the whole video. Now we will be switching towards admission of a partnership in the next session.